There's one for you, 19 for me.
Did you get your billions back from the IRS yet?
Because I'm the tax man. Yeah, I'm the tax man. Hello, my name is Barry Horvath, and I'm the tax man. And this is Moving Forward TV, your local market update.
And I am DeLynn Gaston. Thanks for joining us this week. We are talking about taxes, and we know tax time just passed, but maybe there's some deductions that people might have. Some deductions, perhaps, that you might have missed. All right, this week we are talking about some of the myths regarding your mortgage and deductions that you can take and your taxes. I know that for the most part, everybody's already done your taxes unless you're Stop with the tax man. Unless you're maybe a statistic and you're on extension until October.
Otherwise, the quality of these things, it's just amazing.
Otherwise, maybe we can give you some tips for next year and some deductions. You want to join me on the show here or what?
Oh yes, home improvements. Are they tax deductible?
Number one, home improvements. Are your home improvements tax deductible?
I don't know, DeLynn. Are they deductible?
No.
All right, first of all, let me do my disclaimer. We clearly are not tax professionals. Okay? Clearly. So you should
even though you're singing you're the tax man.
We do have some good information here that we have gathered, but you should consult your professional tax advisor for more detailed information.
Please do. You know, we've looked up some of this information, but what we've learned is that you need to consult a professional tax advisor.
Now, here's the fact. Can you deduct improvements or not?
No.
Okay, you technically cannot, from what we're told. My good uncle, Sam, he says that if it's for updates, so forth, yes, it may be tax deductible. But if it's for true improvements like a room addition or something like that, then it is not tax deductible.
Right.
Now, the exception to the rule is if there's energy
efficient things. Yes, that's right.
Like if you're putting in the
energy efficient windows or something like that.
The updated AC, you might get tax credits. I mean, that's a whole show in itself. So keep that in mind.
The next one is homeowners insurance or insurance. Homeowners insurance and flood insurance, no. A lot of first-time home buyers don't realize this, but no, that is not a deduction that you're allowed to take. However,
there's always a however with
There's always a however with all of it. It's the tax stuff. It's the government. There's always howevers. Anyway, no more tax.
I'm the tax man. Yeah,
if you put less than 20% down on your house, or if you obtained an FHA loan, you are paying something called mortgage insurance, PMI or MI that you might have heard of. That is tax deductible.
However, this is my however. If you got your home refinanced or purchased after January of 2007, you could potentially deduct the MI or PMI insurance, just like you do your mortgage interest.
Disclaimer. Once again.
Yeah, once again. However, if you made an adjusted gross income of over $100,000, it phases out. And if it's I believe if you're
adjusted income over 110, you don't get that.
You got nothing at all.
You don't get that at all. The other thing to keep in mind, this particular PMI deduction ended
2013.
the end of 2013, and the government has not extended it just yet.
Because they've been really busy.
We're hoping they will one day, but so far, no, it ends after this year.
DeLynn, here's one of the biggest myths of all.
I know, this is a biggie.
If you had a home and you bought it and you took a loss on it, it's actually not tax deductible.
Right.
So go figure.
A lot of people think that is.
Yeah, so if
and
you
that's
buy a
whether
house,
you lost it from short sale, foreclosure.
Right, that's a whole nother thing. Now, if you lost a home to foreclosure or you did a short sale on it, the bank will send you a 1099, but now through 2013, under the Tax Reform Act of 2007, that debt, that 1099, that they wrote off is excluded from your taxation. But if you bought a house for $100,000, sold it for $50,000, you don't get the write-off for that.
Right.
So don't think you do. I mean, you know, mortgage or not, you do not get a tax deduction when you lost. It's just like an automobile. When you buy a car and you sold it for less, yes, you do not get a tax break for that.
The next one is mortgage interest. Yes, mortgage interest is 100% tax deductible. However, they do say, see, there's always howevers. They do say that you have to check with your tax professional. This is a big time check with your tax professional. You can only deduct your mortgage interest if you itemize, and that's usually the reason to itemize, but there's standard deductions that you can take as well. For example, and you have to weigh them both ways. A good tax person is going to weigh them both ways for you. Should you take the standard deduction, or should you itemize and take the actual deduction? If you're a single person, the standard deduction is like $6,100, and if you're married filing jointly, it's $12,200. So if it's more than that, it obviously, in most cases, will pay.
So here's my advice to you. If you buy a $270,000 house, pay 4.5% interest, that's $12,200 in interest you'll pay. If you want to be guaranteed to write off your mortgage interest, buy a house for at least $270,000. There's my advice to you.
Check with a tax professional. Going along with mortgage interest, another thing that comes up a lot is equity loans. Yes, the mortgage interest on equity loans is tax deductible, but only up to $100,000.
And a reminder, you must have equity in your home to get a home equity loan.
Yes.
So keep that in mind.
And regardless of what it was used for, so as we said before, if you like put on an addition or something like that, that addition is not tax deductible. But if you used your home equity loan to do that, the interest on your home equity loan, regardless of what the purpose of the home equity loan was for, the interest is tax deductible.
So if you go to Las Vegas with that money, you're good. You can write it off. What a deal for you. You know what? And another thing to consider is people do 15-year mortgages. You know, think about a 15-year mortgage. You pay more interest in the beginning, and then in the later years you pay less, where in a 30-year it's spread over a greater time. It actually, you lose a tax deduction when you do a 15-year mortgage faster, because you're paying less interest in the later years. And a lot of people don't think about that. How does my, when does my payment being the same, being fixed, cost me more?
Right, you're absolutely right.
If you do a 15-year mortgage, it's gonna cost you more sooner. Property taxes. Now, this is straight from the tax man. You can write off property taxes, whether it's your primary, your second home, or investment property. So keep those coming.
All of them. All of them.
So, let's increase those taxes so you get more write-offs. That's what I say.
Also, going along with taxes is casualty losses on your insurance. Insurance is not deductible, however, your losses are. So we had a couple of storms come through here, flood damage, storm damage, that kind of thing. If it is not anything that your insurance did not cover, that is tax deductible.
That's a great point, DeLynn. So if it costs you $10,000 to get your house back up to standard from damage from a storm or a natural disaster, you can take a write-off for that.
But just remember that you're going to have to document dollar for dollar what you spent over and above.
Right. It cannot be a significant improvement or upgrade. But again, talk to your tax man.
And the other thing is, just going along with losses for a second, if something was stolen or something like that out of your house, that also, but keep in mind you have to have proof. You're stealing my glasses and my coffee. Not my coffee. Anything but.
Write-off for this.
Anyway, if something was stolen out of your house, I get a write-off. But you have to have proof. So you have to have a picture of that item proving that you owned it. It has to be held off-site somewhere or whatever.
So take lots of pictures.
Here's one that I didn't know about either, moving costs. So not if you're moving down the street, but if you had to move for employment purposes more than 50 miles from your current or your former commute to work, then you're allowed to deduct the costs of moving.
Are you going to be leaving soon?
To include, no. No. To include things like, believe it or not, one night's lodging. I thought this was pretty interesting. Temporary storage of your belongings for up to 30 days.
So you can write that
storage.
off?
Yeah, all of that is tax deductible. Disconnecting and connecting of utility bills, and the cost of travel, and whether you hired a moving company to do it or whether you did it on your own, that stuff is tax deductible.
That's awesome. All right, what about capital gains? Those rules have changed. So again, talk to your tax professional about this
is
stuff.
another biggie.
The rules change all the time. So if you don't like them, wait 1 minute. Okay?
Just like the weather.
All right, so here's the rule right now. You have your house, you sold it, it was your primary residence, you lived there, it was within 5 years, and you lived there at least 2 of the last 5 years, and it doesn't even have to be consecutively.
Not consecutive, right.
So just 2 years out of those 5. And if you are single filing by yourself, $250,000 is exempt. If you're married filing jointly, $500,000 is exempt. So that's pretty big
Substantial.
exemption right there. Now, Now remember the flip side, if you took a loss, you get nothing. Nada, nada, nada. Now, here's the other cool thing. When you pay your title insurance, your real estate commission. So I think we should up real estate commissions for all you real estate professionals out there. So
Oh,
we
they
get
like
a bigger
that.
tax write-off. Absolutely. Let's go to 6, 8, 10%. Okay, let's pay them more because you guys are worth it. You can also deduct that and any improvements as long as it's within 90 days of the transaction.
That is very cool.
That's super cool.
Some good tips on here.
Oh, we're back?
For those, we're back.
Oh, sorry.
He's singing away. For those,
That song's stuck in my head forever. 'Cause I'm the tax
for those
man.
people who are stalling a little bit on their taxes, it's good to know now. For those of you who maybe already did them, good tips for next year.
Yeah, so get this information out there.
Share it, like it.
Get it on Facebook, YouTube. We're all over.
Twitter,
thank you
all that
guys
stuff.
for all your shares and thank you for your support because you know what?
They're helping us.
Oh yes, they are. But you know what else?
What?
We are today and every day.
Moving forward. We'll see everybody next week.